And Greg, will let you go ahead and just take it away and introduce yourself as you'd like.
All right, Gregg Ibendahl, farm management specialist at K-State. So there's been a lot happening in the fuel and fertilizer markets this last several months. If you guys probably stopped to fill your pickup truck up with diesel fuel, you notice how much more you're paying these days. There's several things going on with that, both domestically and internationally, both that are affecting that. So let's kind of get into that and see what's going on. First, talk about oil, gas, and diesel. So as I mentioned, things have gone up quite a bit. If you look at right here, since the beginning of fall into summer, we've seen this big jump up in the highway prices. This is the national price. The local price would certainly be a lot higher because the domestic issue, which I'll talk about here in a bit, is put more pressure on prices here in the Midwest than it probably does the rest of the country. But having said all that, we've seen a nice decline since really the Russian-Ukraine war kind of started right here, and then oil prices fell, and of course diesel prices fell along with that because they are highly correlated. So we get to this point here, beginning of fall, and then we've seen this uprise here, and this dotted line you're seeing, this is actually the price in real dollars, which is basically putting everything on the same terms of dollar width in terms of inflation. So looking at that perspective, even though things seem high now, from a real dollar perspective, it's really not quite as bad as what it may appear to be. There certainly have been times in the past, like 2008, for example, where it got really high, but kind of get used to these periods right here where it's kind of low, and then suddenly go back up to here. It seems like a big shock to everything. So we have world supply as a concern, and then also we have still have this issue in the U.S., which I'm not sure we'll ever have it totally resolved. Is really we just don't have enough refinery capacity here in the U.S. We use our refineries pretty hard, probably anywhere from 95 to 97% capacity practically all the time. So any kind of little hiccup at all in the system really can constrain our supply and cause pretty severe price shocks when they do happen. So that's an issue. We're still growing as a U.S. economy, so I think we're going to keep using more fuel. The only thing that may counter that is how quickly we actually move to making more of our vehicles electric. There seems to be a big push in the U.S. these days to get everyone to buy an electric vehicle. Well, if we do that, that will certainly, I think, help reduce the demand for fossil fuels. It actually could be a good thing for farmers because that would free up more diesel fuel for farm use. I don't know if have you guys been watching the news, but California now has passed this new regulation that I think it's in like 3 years they can't sell any more new diesel trucks, and then about 10 years after that they can't have any diesel trucks on the road. So I'm not sure what that's going to do to the cost of shipping. I can't imagine it would be any cheaper to ship something with an electric truck or some other vehicle as opposed to using a diesel truck. So we'll see what happens with that. But on the plus side for that, I guess if there is a plus side, it could make more diesel fuel available for farmers. So that's still to be determined yet, but that's where they're talking out right now. I think they made that agreement with the diesel manufacturers with the idea that they'll have some new technology invented in 10 years. And that's asking a lot, but we'll see. Well, I mean, the U.S. has risen to those kind of challenges before. Well, certainly the diesel price mirrors the oil price, obviously, because that is the main ingredient in diesel fuel is oil. So you can see what happened here with the Russian-Ukraine war when it started, and then the slow drop off in prices, and then this recent run up in prices we see here in the fall here. So notice what happened here. So coming out of COVID, basically, there wasn't much demand for oil or diesel or gas during the whole COVID thing, especially during the lockdown phase. But that kind of started easing up. We started building up demand slowly and slowly, and that raised the price of oil. And then we got to this point here where the Russian-Ukraine war first started here, and there was a big ramp up in price just over a matter of a few days, where it got up to $120 per barrel. And traders, being the nature they are, they tend to probably overreact on both ends about how much it should go up or go down. So they were being very pessimistic here, and then they realized, well, nothing really happened right away. So then it dropped back pretty quickly. And that's kind of typical what you see in these kind of shock situations. You see prices bouncing around quite a bit until they actually come to some point where they can all agree on. So it dropped back down quickly, but then it rose back up a little more slowly. But we ended up topping at about $120 per barrel. And then traders kind of start realizing what was going on and said, oh, well, Russia's still getting oil out there, and it's not really affecting things on world supply to a whole lot. So eventually then prices started kind of declining, and they declined fairly steadily until really about this summer is when they kind of bottomed out, about $70 per barrel. And I think most consumers can stomach the price of gas and diesel when oil is about this price range, not too much out of whack there. But then we've had some issues since then where prices have increased really about from $70 per barrel up to about $90 per barrel now. And I'll talk about the reasons why there has been this increase. Again, it's both really a domestic and a international effect going on there. So what's been happening across the world to affect oil prices? Well, I guess the biggest thing on the supply side is that both Russia and Saudi Arabia have agreed to cut 1.3 million barrels a day, at least through December, to help the oil price out. And so far, that's actually been kind of working for them because I think you can contribute most of that $20 per barrel increase you're seeing to them actually doing this. So 1.3 million barrels per day, it's something to sneeze at. It's only 1% of the world's supply. But again, the oil and diesel and gas markets were in such tight supply and demand balances most of the time that really a 1% decrease can really lead to some pretty good sized price increases that we have just seen. And we'll see. Right now, they're saying they're going to end this in December, but we'll see if they maybe want to extend that further here. So right now, it's mainly Russia and Saudi Arabia doing that. So there's some other OPEC countries that are contributing some to that too, but it would be beyond this 1.3 million barrels per day. There's also been some flooding in Libya. Have you guys probably noticed watching the news? It certainly has impacted them a little bit. I don't think it's going to be quite as bad as what the first reports were going to be. Libya, they're not the biggest oil producer, but they are a fairly significant player in OPEC, seventh largest. I think they're about Libya is about the third largest oil producing country in Africa. So it is a fair amount of oil that they have. And I guess the other thing we can't forget about is the state of our strategic petroleum reserves. So this administration had a policy of trying to control prices earlier, and they released a whole bunch of oil out of the strategic petroleum reserve. So we are now at levels probably the lowest it's ever been in 40 years, and we have yet to fill that back out. So we've actually played that card in our deck now that, use this to help moderate prices because we've already tried that. And really what we need to do, we can't really release any more hardly or very much anyway. So I guess the next step would be to, find some oil prices of when prices are fairly low and look at maybe refilling it back again. But so we've taken this card out of our deck by already drawing that down. Well, what's been happening in Russia for as oil production? Really not a whole lot. They've still been producing quite a bit of oil, just almost as much as they had before the war started. I don't really have the last couple of quarters. This is as far as Energy Information Association, as far as they have data for, but so far not much of a decrease in oil production. But again, that's always subject to change. Never know what's going to happen in a war situation if something would cause that to actually be cut in half for some reason or another. Another point to know about this is that oil is a fungible commodity, so it's really tough to make tariffs work. So we've been trying our best to prevent other countries from buying Russia oil, but really that's really kind of tough to do because once oil gets in the market, how do you say that a U.S. barrel of oil is really different than a Russia barrel of oil? It's kind of tough to make those kind of things work. And historically, that's been the case. Whenever you're talking about something like oil or grains or stuff like that, tariffs really just don't work too well because there are some ways to get around that. It may not be quite as efficient as what they started with, but there usually is at least some type of backdoor. And Russia certainly has been taking advantage of situations like that. So they've been selling more oil to India. They've been certainly selling a lot to China. Now, there's some drawbacks to doing that. So what they've been trying to do with Russia is they're trying to sell oil in the local country price, which means you're kind of tying the money up there to some extent. So Russia's been having trouble getting the money back out of India for various reasons. And, they're not big trade partners for things otherwise. So Russia really has a lot of money stuck over in India right now. Maybe not quite the case with China, but certainly that has a few drawbacks, even if they do have found a market for that to actually work. I would say Russia, for the most part, probably faces fairly close to the market price for the oil they sell. Although I would suspect to get other countries to buy their oil, and China's certainly no dummy when it comes to world politics. China, I'm sure, is demanding some level of discount to actually take on Russia oil. So Russia is probably getting close to the world market price, but I would say probably not the world market price. And like I said earlier, I think these cuts have been effective so far. Russia was able to talk Saudi Arabia into picking up the bulk of this 1.3 million barrels per day cut. Russia's only doing 300,000. Russia's doing a million. And like I said, I think you could contribute most of this $20 per barrel increase really to what Russia and Saudi Arabia have done. Now, whether this works a long time, I think is going to be an open question. because of the mentioned tariffs and cartels don't really tend to work out too well. When OPEC tried this back in the 70s, they did it for a while, but eventually someone's going to cave and they're going to bring some oil on the market just because the price is too tempting for them to avoid things like that. So that they didn't work long term. Now, Russia, I think, has a better chance of making this work long term because it's really just Russia and Saudi Arabia right now undertaking these cuts here. So as long as they can stay in agreement, I think they can keep this going probably longer than what you might expect otherwise. It certainly has helped Russia financially because it has raised the price quite a bit, and they're not really cutting that much in the way of oil out. So that would be a big benefit for them. They're getting more money to fund their war efforts because of higher oil prices when they really didn't have to cut very much of their supply that they put on the world market to accomplish that. So I would say that would be a win for Russia as far as accomplishing what they want to do. The side benefit would be, this certainly enhances the relationship with Saudi Arabia. It certainly makes them stronger partners than what they were before. So that's probably a bad long-term thing as far as the U.S.'s perspective is concerned. And then I think China has been benefiting from this as well, the relationship with Russia and Russia with China in this relationship they developed. Because before this happened, I'm not sure how much world they actually traded directly with each other. This has certainly enhanced that and has probably cemented their ties to each other more than what it was before. So those are some negative consequences as far as what the U.S. is concerned. Well, how has Russia economy been faring in the whole deal? Well, actually, not as good as what I had first thought here. So, this is basically the amount of U.S. dollars or amount of rubles for one U.S. dollar. So, when the war first started here, people were kind of skeptical what was going to happen here. So the ruble kind of collapsed there for a while, but then it got very strong for a while, and it was actually stronger than what it was pre-war. But since then, the ruble strength has kind of eroded. So now it was really worse than before the war started. At the current exchange rate, I think it's like $1 is the same as you get 96 rubles. So the ruble is only worth a little bit more than a penny here. That's not good from Russia's perspective because their currency is not as valuable as what it could be. The good thing here is the U.S. remains the world currency for everything out there. People turn to the dollar when things are tough, and even though we've added a whole bunch of debt to the U.S., to the matter of trillions of dollars now, it seems like in our deficit every year, people still turn to the dollar as a safety net here. So we are the world's leader when it comes to the economy and currency, and that's a good thing for us as long as that never changes. I think our dollar will always be strong here. Um, Russia, their plan, I think, is really to move the U.S. off really to move the world off the U.S. dollar. And I don't really think that's off to a good start so far here. So this idea with trading oil with India, that has really put a lot of money in India's bank that they really can't get back very easily because of some restrictions of moving currency out like that. So Russia has a lot of money stuck over there, and they can't get that back through trading items that they would use with some other countries here. So that hasn't worked too well for them. And Russia would really like to make other currencies, especially the Japanese won, as a oil trading currency. They're really pushing that side pretty hard. So far, that hasn't happened yet. And if I talk to my economist friends, there's different views of whether this may happen or not. Some of my friends say that this will never happen. The U.S. or the rest of the world will never back off the U.S. dollar as far as an oil trading currency. But I don't think that's totally out of the question, because I do see a world someday where the Japanese won is actually maybe a currency equal to the U.S. when it comes to buying oil here. But they haven't got there yet. Until then, I think that puts Russia at a little bit behind the eight ball because of they can't get away from the dollar and these kind of things. Well, what's been happening to Russian export values? Well, if you look at it in terms of just the dollar amount, has actually decreased quite a bit over the last year or so. But really, now remember that what happens is this happened to the ruble as far as the exchange rate here. So I think you could blame most of this decrease really on their exchange rate, because this graph is in terms of U.S. dollars here. So I think if you factor that back out, they probably haven't reduced much of their exports of anything very, very much anyway, at least as far as total volume. Certainly on a dollar perspective, that's the case, but certainly, but on the amount of product they're actually shipping, I don't think that's the case. Just looking at what's been happening with diesel prices over the last year and a half, you can see here's the start of 2022, and we saw this big rise in both diesel and gas prices. And then these things started to decline, and we got to this point here at the kind of the end or middle of summer where things have been increasing thanks to the increasing price of oil. The thing that should stick out to you guys is the fact that in the last 3 or 4 months is how much quicker diesel fuel prices have risen faster than gas prices. And this is a problem when farmers are concerned because this differential between the diesel and the gas price, if you look at this period right here, is really way out of whack compared to what it has been historically. Historically, the gap between the diesel fuel price and the gasoline price has only been about 25 to 30 cents or so. And we were getting back to that level here right about midsummer before things kind of went haywire again. And we're looking at this big gap here again. So from a farmer's perspective, if you had to pay more for diesel relative to gas for other fuel prices, that's not a good thing because they do use so much diesel fuel. And here's what the price premium actually looks like when you just graph that here. So again, here's more the typical range right in here. Here's the worst case scenario when it got back here at the kind of the end of 2022, when it got to about $1.50 a gallon differential. It got to this point here again, which is more the normal range, but now we're probably at least 50 cents higher nationwide. It's probably more than that here in the Midwest for the domestic reasons I'm going to talk about here in a second. Part of it has to do with the domestic reasons is we have very low diesel stocks right at the moment. In fact, we have had low diesel stocks really for the last year and a half to 2 years. So here's this dotted line is 2023. You can see what the stocks of diesel fuel are relative to the last 5 years. And then here's what happened the previous year here. The last 2 years both have been very, very low relative to what they were in previous years here. So that's not a good situation because that's going to put a pressure on price just because we don't have enough diesel fuel. So you might be thinking, well, okay, if my supply of diesel stocks is low, why don't the refineries switch to making more diesel fuel? And they do have that capability to some degree. You can't switch an entire barrel of oil to make all diesel fuel out of it, but there is some wiggle room out there to change your mix of the products you get out of things. Even the EIA doesn't know the exact amount of wiggle room that they have. That seems to be an industry guarded secret, but there is some room, and everyone agrees that they can make more diesel fuel at the expense of less gasoline. Well, why haven't they done that? Well, the problem is the same thing is happening on the gasoline side here. We're looking at pretty low historical levels of gasoline, just like we did diesel fuel here. So that's one of the reasons why they haven't shifted more production to diesel fuel, even though the prices seem out of whack. So the other thing to notice here too is that because our capacity is so tight and we do use our current refineries so much at such a high level of utilization, it's really tough to make that difference up. We haven't built a new refinery here in the U.S. probably in like 40 or 50 years at least. We've been kind of modernizing and expanding as much as we can, but we certainly haven't added any capacity. And in fact, we've taken a lot of capacity away through mothballing some plants during COVID, and the fact that there have been some fires that has really caused some issues going forward here. So any kind of hiccup in the refinery system at all tends to spike prices, and that's one of the issues that we have happened here in the last month. So if you've been watching the news, about a month ago, there was a refinery fire down in Louisiana at a Marathon refinery. This was one of the biggest refineries in the U.S. They refine about 600,000 barrels of oil per day at that particular plant. About half of it goes to diesel, half of it goes to gasoline. That refinery down in Louisiana is really one of the main suppliers to the Midwest here. So we've actually seen a much higher price and spikes here in the Midwest than we have seen in the rest of the country, just because that's one of our major sources of fuel here for the Midwest is that refinery down there. So that wasn't a good thing for the system. And that's why you saw prices really shoot up pretty quickly in the fall when that first occurred. So I think they got the fire under control pretty quickly. So I don't think it was as bad as what traders may have first thought. But again, with a tight refining system, it's going to take a while to recover from that. So just looking at the historical relationship between the oil prices and the fuel prices, here's a graph of the last 10 years of weekly data. This blue line is where we would think gasoline prices should be based on the oil price, and the red line is where diesel prices should be. So based on $90 oil, which is about where we are now, that would lead to about $3.60 gas and about $4.10 diesel. I think we're higher, at least on the diesel side anyway. I would argue that this diesel curve especially is shifting. The historical relationship for gas seems to kind of hold up. But when I went back and did this a few years ago, this line here has gotten steeper over the last several years. And if you look at all these points way up here that are above the line, I would argue this line is going to keep shifting just because of our supply situation. That means as we get higher and higher oil, I think you're going to continue to see a bigger differential between the gas and the diesel price, as well as having higher diesel prices than what you may have been accustomed in the past here. So, unless we can get a refinery system a little more capacity in there, I think you're going to see this red line continue to shift upward and more vertical than what it used to be in the past. Well, where does the EIA think things are going in the future? Again, this is their forecast, and here we are right about here. So, no, first thing I want you guys to notice is how wide their distribution is here. They have a really wide margin between their 95% confidence interval here. So they're saying basically prices could go either way by a long ways here. And then we also have their comparison, which is this blue line versus what the futures markets are saying, which is the green line. I really haven't found the futures market to be all that good as far as making any kind of predictions from, because they tend to, even though they do have, I think, at least 3 years in advance you can buy futures for, they tend to be very steady. They pretty much take the current price and just do straight line for the next 3 years here. So I don't find this futures market really to be all that informative as far as getting any information from. But they're basically saying that oil is going to make it up to about $9 per barrel. Well, we're already above that here, so I'm not sure if they have any more built in as far as what the price is going to be. But they're thinking that we should top out as far as the oil price right now, and then maybe have a very slow decline in the next year. So to me, that may be a little bit on the bit optimistic side. I think there's still a little bit of room for oil prices to maybe go a little bit higher, maybe not a whole lot, but I would say they may be a little bit optimistic on this as well. And again, you can see they're looking at the historical numbers as far as the supplies of gasoline and diesel prices. So, things kind of got bad here once COVID was kind of, after we got through about the first 6 months of COVID, we started using more fuel here. We just didn't bring our refineries back online quick enough. And then we've had this couple of year period now where diesel supplies have been at the very bottom of their typical range, and the same with gas side here. And again, this is going to be a multi-year process, even under the best conditions. If all refineries can stay operational and there's no other hiccups to the system, we don't have any distributions to our imports that we bring in. It's going to take a long time to actually get our supplies to where they have been historically from an inventory perspective. Here's the EIA forecast where they think prices are going to be. So this blue line is the diesel line, the red, and this brown one is the oil price. So here's our diesel price. This horizontal bar, this is basically their year price that they're predicting. So we're in 2003 right now. So they're basically saying diesel price of probably about 440 nationwide for highway diesel fuel. They're saying a little bit of a decline in the coming year here. So that would be a good thing for farmers if that did happen, if we actually did see this decline they're talking about. Well, what can farmers do in the face of situations like this, with fuel prices being what they are and being a fairly significant chunk of a lot of inputs? Well, seasonality is one thing you could consider. Both diesel and gas exhibit some amount of seasonality. I mean, there's certain periods of the year where the fuel is higher or lower than what it is the rest of the year here. So this graph, these red diamonds kind of show you the average of the last 5 or 6 years of where would be a good point to buy fuel relative to the rest of the years here. So you can see for diesel fuel, the lowest prices typically are in January, February. We tend to have a mini bump here during spring planting, but the biggest bump currently is right here in the fall season here. So if you're a farmer looking to buy fuel, especially for fall harvest, don't buy it right when you need it during the fall. Buy it earlier in the year, preferably if you can buy it in January, because that tends to be the cheapest time to buy diesel fuel. Now, for gasoline, there is a very clear seasonality period, and this has held up every time I've ever looked at this and every graph I've ever done, is there's always a bump in the summertime for gasoline prices. So you start about May, when Labor Day, when schools are out and people do more traveling, that holds up through summer, and then things start to go down. But again, for gasoline, the cheapest time is going to be to buy in the wintertime during January when people are driving the least. All right, so let's move on to the fertilizer side. First, I want to show you a graph of where farmers spend the most chunk of their money. And this is a relationship to all of your production expenses for each of the different categories. And you can see how it's changed from 1978. This is, again, based on our KFMA farms, based on 78 when we have good computerized records, up to what happened during our last year where we have data for how things have changed here. So machinery still is the biggest expense category in all farms. This would include not only the machine cost itself, depreciation, but it would include repair and maintenance, and also diesel fuel is rolled into this as well. If I would separate diesel fuel out, diesel fuel typically about 6% of total farm expenses. So machinery is our biggest chunk of money, but the second biggest category now is turns out to be fertilizer. So fertilizer is about 20% of production expenses relative to all expenses. Seeds about 15, and then labor seems like it's a lot when you pay someone a lot higher wage than what it used to be. But in the scheme of things, labor is really pretty small. Herbicides are another big chunk of expenses, about 15%. The other thing I want to point out here too is interest now is only about 3% of total expenses. But think back to the 70s when we were getting ready into the farm crisis. It was about anywhere from 12 to 13% at that time. And that was really bad news for farmers whenever it got that high. So things seem low here, but a big rise in interest rates would put us back in the same boat again. Comparing about what happened 2 years ago, this is based on the USDA indexes, price indexes, and I'm just comparing what happened to current prices relative to what they were 2 years ago. You can see we had this big run up in fertilizer prices. They have since gone down, but really fertilizer prices are still about 25% higher than what they were 2 years ago, even with the big drop off we've seen here. So it's still a pretty significant expense. And again, fertilizer is our biggest expense category. The surprising thing is what happened with herbicides during the course of 2022. They went up over 80% during that time. They backed off a little bit, but relative to 2 years ago, herbicides are still 60% higher than what they were before. Diesel prices, luckily, they've gone back down, probably maybe just a touch lower, or about the same as what they were 2 years ago. But again, that hasn't factored in this recent rise in diesel fuel prices that we've been seeing here. So we'll see what happens with that going forward. Russia obviously is a major player in the fertilizer market, not only for their own use, but they're one of the world's leader export of fertilizers. They export really all three categories of fertilizers. So they're well set up to provide the agricultural world with the three processes. As far as ammonia is concerned and any of the nitrogen fertilizers, we're lucky in the U.S. we have a large supply of natural gas because that is the key component of producing ammonia, which then goes on to produce anhydrous, which then goes on to produce urea and all the other nitrogen fertilizers here. So as long as the country has natural gas, you can make your own nitrogen fertilizers, not a problem. And we have plenty of natural gas in the U.S. for the moment anyway. So it's not going to be an issue. There's this process called the Haber-Bosch process where they literally take the nitrogen out of thin air. The air is mostly nitrogen to start with. By using this catalytic process, by burning natural gas, they're able to produce ammonia gas like that. So I couldn't begin to do it, but that's just what I've read about it. And so as long as you're set up to do that, to have natural gas, you can make your own ammonia. And we're self-sufficient in the U.S. as far as for nitrogen fertilizer is concerned. As far as potash is concerned, again, Russia is one of the world leader producers of this, 20% of world production. This is the one place I worry a little bit about us as a fertilizer situation, because this is the one fertilizer ingredient that we don't really make or not really make, but we don't really mine in the U.S. because we have to import all of ours, and most of ours comes from Canada here. So this potentially could be a roadblock somewhere down the road, because if Russia wasn't able to get their potash out there, that would lead to a pretty steep rise in potash prices. And with the U.S. being dependent upon imports for all those things, that would be bad news for us here. So luckily, I think potash right now, just talked to my cousin my family farm back in Illinois. He says potash is about low as it's ever been. So now might be a good time to stock up on potash just because the price is pretty low here. As far as phosphate rock, again, we're almost self-sufficient in this. So we're not really worried about this because we do have plenty of production. Again, Russia produces a lot of the world's phosphate rock too. So I have a model to predict anhydrous price. It's based on three components now. It's based on the corn price, it's based on inflation expectation, it's based on the oil price here. For a while there, before we had this big run up in anhydrous price a year or two ago, my model wasn't working too well here. So I had to go back and add back in inflation as a component. When I did that helped my model work a lot better here. So now I'm basically able to get R squares of 0.72 as far as looking at the relationship to historical data. So it works pretty well. And you can see how the model, this is my current model that I just did a couple of weeks ago about what plays into that here. So basically, with this $20 rise we've seen in oil prices over the last 2 or 3 months, based on what I'm looking at here for oil, that would really translate into probably about a $55 to $60 increase in the price of anhydrous ammonia because of that. And you can see what anhydrous prices have done here. That would be the red dotted line would be the actual prices. The green one is what my model is predicting here. So I haven't quite caught up to where the prices currently are. But over here, you can see this little blob here. This is kind of where I was predicting late summer when we had a risk and profit conference. I was basing this on like $90 oil, $5 corn. I forgot what I had for inflation. I think maybe 6% inflation or something like that. According to that, my model says that really anhydrous is probably lower than what I think it probably could be because I don't have $1,000 anhydrous out of the question here. So that makes me think we may be. I think we're really looking at the bottom as far as anhydrous and really probably all the fertilizer prices are concerned because of that. Because my model would say that really fertilizer is probably lower than what I might expect it to be. And in addition to that, we also have some big unknowns here about things with the Russian-Ukraine war. It's still going to be a big factor whether what that might do to oil prices if we actually have a recession in the U.S. Would that reduce demand for things? What's going to happen with the whole inflation side of the world? And then really the last component would be what happens to world oil price? Right now we're looking at $90 per barrel. Is that going to be the price going into next year, most of the year, or are we going to come back down at some point in time? And I guess to go along with that is Russia and Saudi Arabia. Are they going to keep their current supply cuts in place going forward? Luckily for I'm predicting anhydrous, really that's a key driver really to all the fertilizers here. So there's a strong correlation with all these as you might expect. But even things like potash, where there's not a direct ingredient of anhydrous or nitrogen in that fertilizer like there is DAP and MAP and the other ones, there's still a 0.79% correlation. So really, whenever the anhydrous price goes up, really all the fertilizer prices are going to go up as well. And I'll just kind of end with this as far as I think net farm income is going to go with having said all this. So certainly the expense situation is a lot better now than what it was in 2022. I think for this year, we're probably going to look at a case where I think revenue is going to be about the same as what it was the previous year in 2022. I think crop insurance is going to make up for the fact that we're probably looking at lower grain prices overall for the state, which makes my net farm income when you say have kind of steady levels of revenue and prices being down thanks to lower fertilizer, herbicide, and some other things. I think we're looking at this increase in fertilizer. Increase in net farm income. Basically, from here would be the median point right here. So we went from like what we had last year, about 100,000 up to maybe like $150,000 as far as net farm income increase. But then going into 2024, I think at that point in time, those lower grain prices, if the current futures market is any kind of guide for that, we're gonna back off that again, which is a little bit concerning here. But again, that's over a year in advance, and a lot can happen in a year here. But I am thinking we're going to have a better bounce back year. The only thing that might temper that would be how much of those savings in lower fertilizer prices and chemical prices and seed prices and oil prices are going to show up this year relative to next year here. So this could kind of move this relationship around a bit here. But that's kind of my idea where I think things are going forward and how fertilizer affects everything. But again, with fertilizer being 20% of a grain farmer's production expenses, the direction of fertilizer prices makes a big deal to what the final net farm income number is going to be. So questions, comments?
Folks, go ahead. We just had one comment early on. If you see it there, he noted they're saying we're going to see $100 oil again by this fall. Is this plausible? Just comment on that.
Oh, I think it's very much in the possibility. I don't think you can discount that at all. Again, a lot of it may depend on what happens in the Russia-Ukraine, what their supply is like. But certainly we can see any kind of disruption at all to the U.S. supply is very quickly going to happen with a spike in prices here. So we have a hurricane come through maybe here toward the end of the hurricane season or something else like that, or maybe another refinery fire, just because our supply and demand, they're so closely tied together with that supply being very constrained to what we can do with our current capacity, that it's hard for us to catch back up here. So I don't rule that out. I wouldn't necessarily put it in my forecast for next year, but I would certainly think that would be a fair possibility of happening next year.